Fabulous. All right, we are recording. Welcome, everyone. Thank you so much for joining us. My name is Aaron McMurray. I'm Chief Strategy Officer with Innovia Foundation. We're glad you're here with us today for the first of two virtual workshops around Innovia's environmental, social, and governance pool. We're really excited about this addition to our overall investment strategy as a community foundation, because we believe it's a way that not only we can grow the impact of charitable funds, but we can do so in a way that offers donors and fund founders and nonprofits that have endowments an investment strategy that is socially responsible and allows different ways for people to grow those invested charitable funds. So we're excited to share more with you about that pool. And that's the purpose of today's meeting. Again, we're recording this. And to introduce our speaker, I'm going to turn it over at this time to my colleague, Lauren Autry. Lauren is Innovia Foundation's Chief Finance Officer, and she's been with the foundation for 4 years now and brings so much expertise around our investments and the long-term growth and management of all of our charitable funds. And so with that, I'll turn it over to Lauren, and Lauren will share a bit more about our program today and introduce our speaker and facilitator. Lauren.
Thanks, Aaron. Welcome, everyone. It's so good to see you. Yeah, we're very excited today to provide an opportunity for everyone to learn about our ESG pool and why, as a foundation, we thought it was important to start an investment sleeve with the ESG lens through it. I have the honor of introducing Tim O'Donnell with FEG, which is Fund Evaluation Group. Tim's been working with us since about 2014, I believe. FEG focuses mainly on institutional fund management for organizations such as healthcare and community and private foundations, as well as other nonprofit and charitable entities. They currently advise on approximately $65 billion in assets and have clients all across the United States. Tim also leads the ESG group for FEG, and he was instrumental in helping us as a foundation walk through that process and officially form our ESG pool back in October of 2018. And fun fact about Tim is he's just an avid motorcycle racer, which is an awesome thing for a finance guy to be into. So welcome, Tim, and everyone, and let's turn it over to you.
Yeah, it's fun to be into motorcycles. It's also not fun to be into a sling, which up until just a couple of days ago I was, because of motorcycles. So there's both sides of the coin there. Lauren, thank you very much for the introduction, and everyone, thank you for joining. I'm really excited about kind of giving you a little bit more information about the ESG pool, and Lauren did a pretty good job of kind of giving the background. But we started. Well, I started doing, at the time, it was just called SRI, or socially responsible investing. And this was probably 1997, 1998, when I first started in the industry. And it was finding US large cap managers that would adhere fairly close to the Catholic bishops' guidelines for investment. And that was really about as far as the industry, at least at that time, really went. It was primarily exclusionary screening. It's let's identify the things that we don't like or we don't agree with, and let's get them out of the portfolio, right? And that's noble. That's noble, and it still is used quite a bit, very frequently here still today. But what we've seen over the past 15, 20, even 25 years is a real evolution and maturation of the responsive investing landscape. And so, getting rid of companies that you just fundamentally disagree with their business practices makes perfect sense. The ESG portfolio that we are going to be talking about today does that very thing on a variety of areas: alcohol, tobacco, gambling, adult entertainment, to a lesser extent, fossil fuels, things to that effect. But also the markets also recognize that, hey, there's value in the process of looking at ESG considerations or qualitative sort of social reasons. There's value in looking at these portfolios, and we think actually this can help us generate a meaningful rate of return, or an outsized rate of return. And so what we've seen over the last many years is this concept known as double bottom line, where our investments are designed to generate both a social return as well as a financial return. And this is not an either or proposition. This is think and. and not or. You can have a social return and a financial return. And I think also what we've seen over the last several years is investors sort of looking beyond what were the commonly held conventions, even though they weren't necessarily true and certainly aren't true today, the commonly held conventions as to why to not invest in responsible portfolios. And the idea is being the values of the organization should be reflected in the grant making. That's where it should exist, and it should only exist there. The rebuttal would be, or one of the concerns people would raise as well, they're too expensive. The fees are too high. Others would say, well, you underperform, right? And if you injected social components or values into the portfolio, you're doomed to underperform the portfolio. And then the other chestnut is there's just simply not enough investment ideas to go around. There's been a lot of give back on those myths here over the last several years, and many investors are realizing that that's exactly what they are. They're myths. So, with that, I've got a little presentation, just kind of give you a real quick layout of what the market looks like, the responsive investing market looks like right now, and then some information about the ESG pool that Innovia has a little over $3 million invested in now, and what we're doing here today, and follow-on meetings, and what staff is working very hard to do is to make sure that the community is aware that this investment option exists, because we firmly believe that the more people know that this investment option exists, the more that people will take advantage of it, right? So with that, I'm going to share my screen. And by the way, if you have any questions as we go along, either just voice them, or if you want to put them in the chat box, whatever you want to do. If we spend this whole time answering your questions, I'd be delighted. So okay, so here we have the deck, and just to kind of give you a rundown, and this is sort of what I hit upon before, is that the one thing about the responsive investing world is they love their acronyms, they love their terms. So SRI, ESG, MRI, PRI, impact, all are different in some respects, but in the Venn diagram of all of these, there's a fair amount of overlap. Right. So socially responsible investing is anymore kind of held under the assumption that it's primarily negative exclusionary screening. And that's really about as far as it goes. ESG is much more holistic. And then ESG, mission-related impact investing, are sort of offshoots of a fully activated portfolio, fully engaged portfolio, where you can find investment ideas all across the investment landscape. When we're talking about ESG, this is probably the most commonly held or most commonly used term here today. And ESG, of course, standing for environmental, social, and governance components. And you can see some of the examples of what an environmental consideration would be, social consideration. And again, a lot of this stuff is common sense, right? So if you look at a company that burns fossil fuels to produce whatever it is they're producing, say it's a utility and they're burning natural gas to produce electricity. Well, it stands to reason that if that utility is using natural gas to the most efficient way possible, they save money because it's a cost input, right? If you look at a company that treats their employees well, they have higher employee satisfaction, they have higher employee retention, and it's much easier and much cheaper to retain an existing employee than it is to go out and hire a new one. So keeping your employees happy can add value, right? So a lot of this is common sense information, but oftentimes traditional financial analysis doesn't take it into consideration, or at least not completely. And what we're seeing here in the industry is that a lot of investors are coming around to the idea that ESG actually does have value, both again, from a social perspective, to affect change from a social perspective, but also to generate financial return. And you can see over the last 10 years or so, the massive upswing in terms of ESG incorporation by money managers. And what you're seeing here is really you have two types of investors meeting halfway. You have investors that say, we are ESG first, we are ESG forward, we incorporate it in every part of our decision-making. And so those managers are generating additional dollars from investors because investors like that concept. You also have some very large money centers, particularly in Europe, that say it would be foolish for us to not incorporate ESG criteria into our decision-making. So it isn't that they said we're now ESG managers, but we are managers that use ESG criteria in the decision making. So those two types of managers have really been what has spurred this massive growth over the last 10 years or so. You can see it in terms of public strategies. One of the other things we've seen is an explosion of publicly traded securities, exchange traded funds, mutual funds, many of them passive index strategies with meaningful growth here from quarter over quarter. And this actually comes from the Morningstar Sustainability Funds report. The most recent report, which we actually have, but not in this presentation, shows a continuation of it. It's just a massive amount of dollars flowing into ESG and sustainable funds. Even if we bring it a little bit closer to home, this is actually off of our community foundation survey that we do every year. This year we had about 110 community foundations respond. And in 2017, when we first started asking questions about whether community foundations had some sort of ESG investment, in 2017, 16% of respondents said that they did. This year, in 2021, 55%. So you can see you are not alone as a community foundation in incorporating some sort of ESG. Many community foundations are doing exactly what you've done in terms of establishing a separate investment pool. In terms of performance, this is as of March 31st, but all this is just kind of a cross section of several ESG indexes versus their traditional index counterpart. So, you know, the MSCI USA ESG Universal Index versus the MSCI USA Index. The only difference being in all of these indexes is ESG criteria is incorporated into it. So the idea that, well, if you invest in an ESG strategy, you underperform, our opinion is that whether you outperform or underperform has very little to do with whether or not you're ESG, but rather how good of a manager have you selected. And actually, we see in the vast majority of events and time periods going back, and really, quite frankly, over the past decade, ESG not only doesn't underperform, but in fact outperforms the non-ESG variant. In terms of how the community foundation is invested, it is a diversified portfolio, stocks and bonds, real assets, in approximately 60% stock, 40% bond allocation. So core fixed income and high yield making up 40%. US stocks about 27%. You can see international, emerging, and what have you. And we populate it with about 15 or so underlying managers, either ESG specialists, so firms like Boston Common or Morova or Parnassus. These are firms, this is all they do is ESG investment management. Or we'll have some passive vehicles like the Vanguard FTSE Social Index or the TIAA-CREF Social Choice Low Carbon. So the idea here being is that we want a high level of actively managed strategies because we think active management has a place in ESG strategies, largely because corporate engagement and activism is an important component, and you really only get that through actively managed versus passively managed. We also like the idea of it being specialists, right? So Boston Common just focuses on ESG international strategies, focusing primarily on climate and gender and racial concerns, right? KBI is a global water strategy focusing on water tech and water savings, right? So we get another layer of diversification through the portfolio. We have diversification for manager, we have diversification from asset class and geography, but we also have diversification from areas of emphasis from an ESG perspective. So this is really designed to provide a solution to a very disparate group of potential investors, whether it's faith-based, environmentally focused, perhaps it's the local animal shelter, whatever the case may very well be, whatever is important to that organization. Ideally, this portfolio has something to offer. Getting a little bit deeper in, this is the ESG component of the portfolio, or the equity side of the ESG portfolio. And so you can see roughly 55% of the stock side of the portfolio is in the United States, about 45% in non-US, which is right in line with the index. This is the list of all of the managers on the public equity side. So again, Boston Common, Boston Trust, Calvert, Eventide, KBI, Morova, Parnassus, these are all ESG specialist firms. Other strategies like the DFA's, both International Core and Emerging Markets Core, or TIA-CREF or Vanguard. These are ESG strategies within a larger fund family. But now we also incorporate ESG, not just on the stock side, but also on the bond side. So Pax World on the high yield side, TIA-CREF on the bond side, PIMCO. We're actually in the process of just finally vetting 2 more fixed income managers that we will likely be sliding in here sometime in the next few months. You also have exposure to Access Capital. And Access Capital is a little unique in that it's a bond strategy, but it buys Community Reinvestment Act qualified bonds, and it buys them up through the greater Spokane area. So you have direct local impact addressing affordable housing within Spokane through this strategy as well. And then lastly, we've got performance. So the ESG pool from Innovia dates back to November of 2018. So these are these numbers here. The Innovia strategy follows our discretionary strategy, which we have almost a 10-year track record on. So that's what is listed here in green. But the takeaway here is as of June 30th, Innovia is up 10% year to date, over 35% over the past year. And you can see for our discretionary strategy, which is what Innovia follows, almost double-digit returns going back over the last decade. So we're very pleased and proud of the performance. We've done it in a sensible way. I think it's also important to point out this is a 60-40 portfolio. This is not a go for broke portfolio. This is designed to be an all-weather portfolio. It's a portfolio designed for you to be able to sleep well at night, knowing that you're doing good and you're doing well with your investments. In terms of impact, we use the United Nations Sustainable Development Goals, broadly 17 sort of big picture items like poverty, hunger, education, gender equality, on down the line. But we are able to take the entire portfolio and then benchmark at the individual holding level, the individual company level, what companies are positively aligned with one or some of the 17 United Nations goals. So we're able to take the portfolio and say, okay, percentage-wise, where do we have the greatest amount of alignment? In other words, of all of the really big issues around the globe, how is the ESG portfolio for Innovia, where does it have its largest exposure and efforts? And those being gender equality, affordable clean energy, economic growth, responsible consumption, right? So that's that analogy that I gave you about a utility using natural gas efficiently as possible. And climate action, trying to actually affect change. So, the idea being climate action says, we know that there's problems, now we need to find solutions. So we have a portfolio that is focused very heavily upon gender and racial concerns and environmental concerns and economic growth. Areas that, quite frankly, are absolutely in need. What you'll find are impact strategies for community foundations that have had an ESG portfolio for quite some time. We'll address things like poverty and hunger and education through impact or short-term loans or low interest loans. This portfolio is designed to generate return above and beyond the market. In terms of exposure, we use MSCI for scoring. So from an overall quality score, E, S, and G scores, your portfolio ranks better than the overall market. You can see exposure to the commonly held sin stocks. We've also included some of the positives. So your exposure to migrant detention is well less than the market. Your exposure to the prison industry. Your exposure to clean energy is more or almost double what the overall market is. In terms of predatory lending, firearms, adult entertainment, on down the line, very trace positions within many of the sort of negatively held stocks. But then we can also take your portfolio and put it in context of some things that are a little bit easier to understand. So for every $1 million invested over the next decade in the ESG portfolio, you can see where change will happen. So almost 500 more homes powered by clean energy, almost 12,000 more solar panels built and installed by the $1 million over a decade based upon how the portfolio is allocated. Over 1,200 additional meetings led by women. So again, we look at this and we say, all right, based upon this, the ESG portfolio focuses on environmental considerations and climate action. and gender-related and racial-related issues. To no surprise, it's where we see the biggest move and biggest impact on a go-forward basis. So again, the idea of responsive investing it's now mainstream. It's not going away. You can have a mission-focused, mission-aligned portfolio that should and can outperform the broad markets, much like we have seen in the Innovia portfolio. And whether we're talking about clean tech, gender and racial considerations, climate, housing, healthcare, on down the line, the ESG portfolio has something there for a fairly disparate group of investors. That's about all I have. What questions can I answer? Concerns? Now's the time you can tell me I'm completely wrong and loony. Well, if anyone has any other questions as they arise down the road, please. Yes, you can get the slide deck.
Yes.
If any other questions arise, by all means, reach out to staff or reach out to me. I'm happy to answer any questions or kind of walk you through anything else in the portfolio.
I have a question.
Yeah.
Ron Cocciarella here. You mentioned fees. What are the fees for this ESG versus consolidated for Innovia participants?
Yeah. The underlying expenses for the managers, right? That's really the part that we pay attention to. The fees that the foundation charges, Lauren can get into that. But the fees that the managers charge, weighted average on the portfolio that we manage on the discretionary side, is about 70 basis points, 70.
Okay.
7-10% for those others.
Okay. How does that compare with consolidated funds, Lauren? Or
correct me if I'm wrong, Tim, I'm pretty sure the consolidated pool and the ESG, the underlying manager fees are almost similar, right? They're about 70 basis points, maybe a little higher.
Yep.
The administrative fee that the foundation charges for administering the fund, if is not based on which investment you choose, it's based on the type of fund that you have.
so it's different for each fund, or it's
Correct.
the same?
Correct. Based on the type of fund you have. Our scholarship funds have the highest fees, and then our lowest fees are our nonprofit partner funds as well as designated funds. I believe our donor advised funds are at 1.5%.
Okay. Thank you.
Hey, Lauren, in the chat function, question that was asked about what the minimum investment is.
The minimum investment in either pool would be $10,000. So we're just asking if your fund balance maybe is just at or above 10,000, you can elect to move the entire balance. If you have 20,000 in your fund and you'd like to keep 10 in each, you are welcome to do that as well. But we ask that you whichever investment option you choose, it has a minimum of a 10.
I had a question. Sorry, I'm not sure if my audio is coming through well or not, but
It's coming through just fine now, yeah.
okay, great. So in terms of, there's been a lot of talk about narrowing and solidifying the definition of ESG, and the CFA Institute, maybe even the SEC is looking into this. Are more managers starting to focus on those UN goals, or is there more consolidation, and are there concrete definitions around what we should be looking for ESG definitions?
Yeah, I mean, I don't think you're ever going to get complete agreement in terms of what ESG is, right? Because it's so unique at the individual investor level. We see at the corporate level a greater amount of use and reliance upon SASB standards, so sustainable accounting standards. From a portfolio level, we do see a growing use of the UN SDGs, the Sustainable Development Goals, to kind of get a sense for how an overall portfolio is positioned. You're seeing also more and more managers in their annual reports or their impact reports will talk about where they have the greatest amount of alignment from an SDG perspective. Now, I don't know if the SDGs are the long-term true perfect answer. I don't think there is a true perfect answer, to be honest. But what I do believe is that if there's a better way of benchmarking and measuring a portfolio than the SDGs, that idea will likely flow through as a result of the SDGs. So for right now, that's one of the best approaches that we have. The challenge is that it is very subjective, right? So while we would never do this, let's say you say, well, I own Amazon and Amazon owns Whole Foods. So I've got that whole zero hunger thing taken care of. I can check that off the list, right? That is very obvious greenwashing. And that's very easily challenged and shut down. But if it's a manager that has private strategies or a whole host of strategies, you have to be able to rely upon the manager that they are truly trying to align their portfolio to an SDG and not just making it whitewash or greenwash.
Great. Thank you.
Well, Aaron, Lauren, I'll turn it back to you if there are no more questions.
Great. Excellent. Thank you, everyone, for joining. We appreciate you making time to be a part of the workshop today. Thank you, Tim, for your great counsel and partnership with us to grow these charitable funds and maximize our investment returns. As we all know on this call, looking around the virtual room, each of you represent a charitable fund that's making a profound impact in communities across our region and for the benefit of nonprofits. And it's a privilege to be a part of that kind of work and know that we're partnering with all of you to make an incredible difference in people's lives and to benefit nonprofits that are doing really important work in our region. So we're grateful for this. Thank you for the time to be with us today. As Tim mentioned, if you have any follow-up questions, please don't hesitate to reach out to any of us at Innovia, Lauren, Chris Stiles, PJ Waters, or myself. And we look forward to seeing you again soon. I'll actually take this opportunity before we hang up to let everyone know that we have finalized our date for Innovia's annual reception, which is our largest gathering each year of friends and donors, nonprofit partners. That date is Monday, October the 4th at the Spokane Convention Center at 4 p.m. If you want to mark your calendars, we'd love to see you there. And in the meantime, stay healthy, stay safe. Thanks for being with us today. Have a great rest of your week.
Thank you.